Next form of financing, I made a category of next form of financing that if you are a small company, but you want to get funding from the global channels, if you want to go abroad, not go abroad physically, but if you want to raise your funds from abroad, then there are also possibilities, even though you're a small company. The first category is called foreign bond market. Okay? The foreign bond market is very interesting in the sense that bonds are issued by a foreign entity, for example, a foreign corporation or a foreign government, denominated in the domestic market currency. So, for example, if a Australian company want to, it could be a small company, but they want to raise money from Finland, who knows? Then they can issue some bonds in the Finnish market denominated in Australian dollar or euro. That's my question. No. If Australian small and medium enterprise wants to get the funding from the Finnish investors, so then the Finnish market, because in Finland, people would like to buy those bonds or the bills, of course, by paying euros. That is called foreign bond market. And it's a very interesting name because the name is after the country's some funny thing. Like if it's an American, it's a Yankee bond. So if some American company, if some non-American company wants to raise money from the American investors, it could be called Yankee bonds. So this bond would be let's say this is an Australian company want to borrow money, raise funding from the American investors. By issuing bonds, they can call it Yankee bond. But if the same thing happens in Japan, make sure that it's not American company raising money in America. It's not a US company raising money in the US. It has to be the non-US company. And same way, a non-Japanese company is raising money in Japan. Samurai, Bulldog bonds, Matilda bonds, and Maple bonds. Any idea where you can get these bonds from? Huh? How about Bulldog? Any idea? Huh? England. So if some non-English company is raising money in Britain, and they are raising in British pounds, of course, then you can call them Bulldog bonds. And if it is Matilda is in Australia. So if you do in Australia, it's Matilda. And Maple, of course, is Canada. So what do you think? If some company want to raise bonds in Finland, what should be the name of the bond? Karhu or what? What should we name it? Sauna? Sauna can be good. So they are, and slightly variant is called global bond, that a company is issuing bonds always in American dollars. So they issue, they want to raise money in Sweden or in whichever, or Venezuela or India or China or from Gulf countries, but they would be issuing it in American dollars, denominated. That can be called global bond because let's not forget that American dollar is still a global currency. Okay. So far. The next is called Eurobond. This is interesting. It's slightly variation of those Euro bond, foreign bond, but the word is Eurobond. I want you to read it by yourself and give me some ideas. A euro dollar bond, for example, is denominated in the US dollar and can be issued in any country except the US by an Australian company. Okay, all right. Let me put it this way. A Finnish company is borrowing in Japan, but in American dollars. So if you compare this one, this previous one here, some Japanese company comes to Finland, or let's say the Finnish company goes to Japan. So I keep the same example so that you think consistently. In this case, Finnish company, now this company would be Finnish in all my examples. Finnish company goes to Japan, borrow money from Japanese individuals or institutions, but in Japanese yen. Here, Finnish company goes to Japan, but instead of borrowing in yen, borrows in American dollars. So the company will not borrow in its own currency. The company will not borrow in the host country's currency, but a third currency. Finnish, euro, Japan, yen, but this Finnish company would borrow neither in euro nor in yen, but in third currency. Let's say American dollars. American dollar is a big one. You know what? There may be possibly more American dollars outside USA. So many times, the countries who, for example, let's say petrodollars in the all Gulf countries, they're flooded with European banks are full of American dollars. Asian banks are full of dollars. So even a country, Australian company, can find it difficult to borrow from American bank. They instead can go to Dubai and borrow American dollars there. Then it's called Eurobond. Okay? And you need to put the in the middle of euro and bond, you need to put the name of the currency. It could be euro dollar, it could be euro yen, it could be euro won, it could be euro rupee, whatever. And this euro have nothing to do with continent euro. So it's like a euro, just a generic term we use. And the reason is that there was a tax interest equalization tax imposed in the US. If you want, I can tell you that interest is slightly subsidized by taxman. The tax authorities treat your interest income a little bit favorably. And this subsidy was even more in the other countries than in the US. So many investors were withdrawing their bank deposits from the American banks, and they were throwing them, stashing them in banks outside America. So as a result, there was a shortage of financial resources in the US, and the interest rates in the US were going up. And because the interest rates were going up, it was causing a problem for the American investors, those who borrow and run the businesses, because then they have to pay more interest. So then the American this tax authority put a limit that beyond a certain limit, you cannot transfer money outside USA, right? And then people innovated a new product, and they said, hey, you know what? Who cares? If somebody wants American dollars, it doesn't have to call Americans to give the dollars. So I will not borrow from New York. I can borrow from Tokyo, or I can borrow from Hong Kong. And then this invention came in picture that you can borrow American dollars outside America. So you can issue these bonds. Does it make sense? So there is a slight difference here, this and this. So in this case, a foreign entity comes to your country and borrow in your currency. Here, a foreign entity comes to your country but borrows in a third party currency. Yeah, so it's a slight difference here. And then there is a euro currency market, or euro money market. The major, of course, American dollar is a big. And once again, it has nothing to do with the, yeah. Yeah. So you can have a, yeah. So this is again, all these inventions, these are financial inventions. This is the world of finance has always been very innovative. And majorly the innovations are meant to bypass the regulatory developments. So whenever some new regulations come and the investors think that these regulations will shackle them, will put them, they will check them, they will push them against the wall, then they invent something else. So they're always thinking ahead of the regulator. So whenever some regulation is stopping you from some financial activity, then they will find some other way out. And euro currency market is very big. It's a huge market. And once again, the major players are of euro currency. The major currency is still US dollars, but the players are non-US companies, right? And it's a very big market, massive. Any idea on daily basis how much foreign exchange transactions we do? Not foreign exchange, but the financial instruments which we trade, like these bills and bonds and things like that. Any idea? Any rough idea? Any fluke? Any guess? Approximately. I mean, there's transfers of bonds, bills. Oh yeah, let's put everything in American dollars. We use the American dollar as a base currency.
The market of forex is about 60 times all the goods, services sold between countries worldwide.
Mm-hmm.
So that market probably is part of that.
5.3 trillion daily basis. Yeah, I'm only talking about those assets with derivatives. You know, the derivatives, risk management assets. I'm not talking about for example, when you want to travel to Britain and you buy pounds at the airport. I'm not counting that. I'm only counting those assets which are meant to do the risk management. 5.3 trillion a day. Yeah, and if we have 250 working days, so you can multiply by 250 and please tell me how much money you get. I'm sure we will fall short of digits. Debt capacity is very important because if we talk about the different instruments that you can borrow against with, you also need to know that the debt capacity is an important factor. Did we discuss it last week? Debt capacity. Yeah, the debt capacity is very important because as a part of your finance plan, it's not a bad idea to talk about how much capable you are to absorb a certain capacity of debt. What is your maximum capacity to absorb debt? Debt is very tempting. Debt can be very alluring for two reasons. The one reason is that there is always a tax advantage to debt, which is not available to equity finance. The reason is that if you see this example, I can give you this example actually. Remember, we were talking about operating cost and stuff. The finance cost was 10. Tax was 10. Yeah. The finance cost is paid before you pay tax. So the interest rate you give, the interest not rate, the interest you pay is tax subsidized because tax is calculated after you had paid interest. But the money which is after tax, the profit after tax, and we assume that 10 was your retained earnings you know, the money which you don't share with the investors, and 20 was the money which you share with the shareholders, called dividend. The dividend is after tax. Okay, it means that this, if there was no tax, imagine if there was no tax, we live in a taxless state, you had 40 euros, not 30, which the shareholders could claim. But their claim is now smaller because of tax. But this doesn't affect the debt. So there is always, we use a word that the tax, the corporate tax rate is always pro debt and unfavorable to the equity investors.
Or the corporation can actually loan money to the company and have the interest then tax free to the corporation which is talking the balance, which it will pay no interest, not taxes. So I suppose also that the benefit because you have the two alternatives.
Yeah. There are different dimensions to it. Yeah. If the tax rate is very low, you have a less incentive to replace your debt with equity. But if in a country the tax rate is very high, like in Finland, the corporate tax rate is as high as 55%, I guess. So in that case, the incentive to have, you know, the tax deductibility is more. You want to escape, you want to evade tax. That's true, but the second reason of debt is that, especially when you're living in an era where the interest rates are generally low, then it will not be, it's wise to take cheaper source of funding. So when you find that people who invest in your company as shareholders would demand more return, because don't forget that different companies' shares could change according to the riskiness. If you invest in a media company or if you invest in a retail store, the risk exposure is different. But if we combine all types of shares, the category is shares, not types of shares, but the shares, and you compare with all types of debt. So if you're only comparing the big word share and the big word debt, then the share are risky than debt. The equity investing is riskier than the debt investing. Because the equity investing in a very bad situation, let alone the full amount of investing, you don't even have to pay the dividend. Of course, there's a market backlash, but nobody forces you. On the contrary, if you don't pay debt and even interest, there are serious legal repercussions to it. So there is more chances, or there is a less exposure to riskiness of debt holders. Hence, the normal expectation, the expected return on debt are lower than the expected return on equity. Because equity is riskier than debt. And the one who's riskier should, by common sense, should get more return. The get or don't get is a different matter. But in theory, by logic, equity is riskier than debt. And hence, equity return expected is higher than the debt return expected. So there are two reasons why debt could be tempting. However, debt can be a silent death. The debt can lead to financial distress Financial distress means the probability of your bankruptcy can increase. Why? Because you definitely have to give up your cash flows. Won't you? Won't you pay interest? Won't you pay back the principal? Whereas in case of equity, there's no such pressure. So this debt can put additional strain on the company's cash flows. So if you're a manager whose company is 70%, 80% financed by debt, I can see that you are really under stress. But if it is other way around, your 80% financing is coming from equity and 20 by debt, then all else being equal, you have some reason to be more creative and more innovative. You are not under stress as compared to your colleague who is having more debt and less equity. Well, I said other things being equal. Yeah. Yeah. Oh, yeah, of course. Yeah. I'm just comparing apple with the apple. Exact same red color apple with the same red color apple, same size, everything same. Your financial distress cost can come in another way. If you have lots of debt already and you need additional funding and you want to have more debt, then the debt covenants, when you got the first time debt, the debt covenants can stop you from additional borrowing. So for example, if I'm your banker and you want to take loan from me, then I can also include one of the clauses that, hey, you cannot borrow from anybody else. If your company requires additional, because if you borrow more, then the same collateral, the same property, which after all, you can only give me the building's paper, right? I'm not capturing your building, you're still using it. But if by anyways you are able to get more loan against the collateral, then I will be affected by it. My stakes are affected. So I don't want that. So, or I may put a clause that in the future you borrow from me, great, take the money. But in the future, if you need some additional borrowing without my consent, you cannot borrow. And because you're a signatory, you can't run away from it. And then what you do? Then you go to the equity market. But guess what? I, as a potential investor, will never like to invest in a company which is neck deep in debt, unless you give me additional premium, risk premium. So what happens? You are trying to say, get some tax advantage, but you have impacted your weighted average cost of capital is up now. Your overall cost of capital has increased. The bank says you can neither borrow more, you cannot borrow at all, or if you borrow more, go and borrow in the some other unsecured market where you don't have to give any collateral. So I fully claim the collateral, but if you borrow in the open market, the interest rates are very high. And the terms and conditions of this unsecured loan are very much pressing. And you feel that, hey, you know what? I already don't have cash flows enough to pay to my banker. How would I generate additional cash flows? And then you say, all right, I go to the equity market, and the equity people say, why should we give you money? Come on. You came to us when you're neck deep in debt. You think we're stupid to give you money? Well, everything depends on everything. That is derivative market. Yeah. At what price? I'm not saying that. Maybe in my dramatizing, when I'm doing this, when I'm making this whole mellow sequence, they're asking for more premium. You think that you will have a cheaper equity when your company is too much in debt? Debt capacity is not an absolute amount. It keeps changing. When the tax rates go up, you can think about more debt. When the interest rate fall, you can think about borrowing more. When your cash flows are very consistent and very healthy, you can think about more debt. When your operational costs are going down, operational cost is going down, you can think about more debt. When company become more known, they have a more history, more legacy, you can get more debt. If a company is making the products and the services which is likely to stay for a long time in the future, you can have more debt. In other words, if your growth prospects are very promising, you can have more debt. But in the other events, if you see the opposite examples, that can make you possibly not so good borrower. All right, so then you have to be careful. When I calculate my cost of debt is coming at 3%. And my equity investors, when I use my model and I calculate that how much the minimum return expect from me is 3.25, then I think this extra 0.25% is not a big problem, because that will save me from what? That will save me from financial distress cost tremendously, which means the bankruptcy cost. Yes. Mm-hmm. Mm-hmm. Yeah. Mm-hmm. Mm-hmm. Yeah. 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 That's right. Debt capacity is a dynamic concept. I think we have discussed, so let's not go too much into it. The debt has some advantage. It has a tax advantage. Definitely. Debt is even better when the interest rates are going down. But another factor which I think can make it goes in favor of debt is that it makes managers disciplined. It's a managerial discipline because they must perform. Whereas in equity investing, they can be laxed. They can become lazy. They can become complacent. They can take things for granted. Like when you study, and you know that if you don't do this assignment tomorrow, your teacher would fail you straight away. On the other side, you have a course or a teacher who is very easygoing and says that, okay, all right, you can't do it tomorrow, all right, take 5 more days. So tonight you can sleep. In the first case, you cannot, because unless you finish your assignment, you will not pass. And there is no possibility of any extension. So the performance pressure on your head is far more than the second situation. So in that case, so we can say that it's like what we use the phrase as a carrot and stick policy. So this like a stick policy, right? So this can add discipline to management, because these managers, they really have to perform well in order to give away the cash flows to the debt holders. Whereas in equity, they become lazy. Disadvantage, there is a financial distress cost, or called the bankruptcy cost, or the agency cost. There could be a conflict between the interest of the principal and the agent. the shareholders would be very angry if you keep borrowing more and more for several reasons. The first reason is that the shareholders know that the interest is tax deductible. And if you borrow more, then this money will not be 10, maybe 15, 20. And then the leftover money, which they would get, would be low. And on top of that, the interest, the debt holders have a the tax advantage also. Because interest payments are tax deductible. So if I'm an equity holder, I'll feel jealous of the debt investor. Hey, my money is, I get the money from share from the profit only when the company has paid tax. Whereas the other guys, they get before this. And I'm taking more risk. So I have a reason to be worried. Another reason as a shareholder, I would be very angry or upset is that if the company actually is in a crisis, then in the pecking order, my numbers come at the last. The shareholder are called residual claimants. Residual means leftover claimant. Mm-hmm. Yeah. Mm-hmm. Yeah. Mm-hmm. Yeah. But I'm in this case, I'm portraying a situation when the company is borrowing heavily, and I feel that I have a reason to be worried of. I will not be worried when I'm really in a crisis. I foresee that, okay, things are going very well, profit is promising, all is good, but can this move away from equity and move in favor of debt? Can it affect my stakes in the future? So I always think I don't have to be in the crisis and only then think about the crisis. I have to make some kind of assessment, because after all, if I'm an institutional investor in your equity, I'm also accountable to my investors also. And I don't have to wait for the doomsday to come and only then getting worried. I have to see that, hey, even though this problem will not arise in the next 5 years, I still have a reason to be worried of. I didn't say it, that they reflect everything. Hmm. How will I convince my investors? Okay, all right, you have a great idea. Even though your financial statements are not so promising, I like them. I like them. And I say, okay, all right, I think there is a chance. But you know what? My investors who invested in my company, they are holding me from my collars. But hey, what are you doing? For me, it's difficult to convince them. I trust you, but I don't trust my investor don't trust me. That's the problem. That is where the problem governance comes. This governance seems like a political governance problem. Like in politics, we have these kind of fights and these kind of permutation and combination. If this happens, this or alliance change, So I have to be accountable to many people, even though I like your idea. Mm-hmm. No, but now you're giving example of mergers. Well, the two companies merge, their capital structure will also merge, unless it's really pushing more towards debt. That could be a problem, but yeah. Mm.
You might pay them more than
Yeah.
small company.
Yeah.
Value.
Yes, so the agency cost, in my opinion, is a strong problem where the principal thinks that the company is borrowing a lot. And as a result, they feel that their stake is getting erosion. There's erosion of the stake. It's like their stake is shrinking. Their position in the company is shrinking. Okay, so that's something could be problematic, and there's a loss of future flexibility. As I said, that if the company is already having lots of debt, and the company can have lots of promising future, as you said, that everything is good. But after all, to realize those dreams and those possibilities, they need money, additional money. But then they will find it very hard to convince those people for the lending. They would say, all right, this is what happened in the startup. You go with a great idea. And the people who are sitting on the other side, they can say, all right, let's not talk about the ideas. How much cash flow will you generate in the first year? Don't confuse, don't impress us with your technical sophistication. Tell us how much, these are our KPI, key performance indicators. How many of these KPIs you can meet in the first 6 months of the establishing of the company? And you say, yes, I'm developing an app which can do nothing. Well, then they say, all right, okay, thank you very much. Or you toe in line with them. But if you start toeing in line with them, if you start getting bullied by them with their list of demands, then perhaps you lose your innovativeness altogether. You get enslaved by the financiers. And the situation for the big companies is not very different from the same. In which terms mean that they may also have the same problem when they want to get more money, because their financing requirements keep changing. So if in the future they require more money and they already have lots of debt, okay, so that can make them, then the situation to borrow more can be problematic. It will not be as bad as a startup, but they will also have more challenges to borrow. So the point I'm trying to say is that the big companies are not immune to these challenges. They also face, of course, they have better channels and better means to meet this problem. They can borrow from multiple countries. If you are a company like Microsoft or Coke or Pepsi, who have operations over more than 100 countries, you have more resources. But then be very sure that you have more problems also. Yeah. And then we have convertible debt. These are very common for the small companies. That you borrow, but you borrow on the promise that you can get your lendings converted to equity. Remember, I gave you example last week. Is that some of you may even say that we will lend you because we think that now investing in your equity is very risky because we don't know you. Or maybe the company, just the project is a failure. But seeing your performance, seeing your success, let's make an agreement that after 3 years, if we are happy with seeing your performance, we have a right that we can convert our debt to equity. So we want to see you tried and trusted first. So first we want to try you, then we trust you. So you have a 3-year trial period where we give you money as a debt, as a loan. Use it, show your performance, show how much market share you captured, show how much operating profit you had, show how your company's market value is going up, show how much R&D have you done. Give the proof. And if we are convinced that yes, after 3 years, we should we convert our equity, a debt to equity? Yes. Then that is called convertible debt. That initially, this is a very safe way, isn't it? Because if you trust me too much and you give me equity, you may lose everything. If the agreement is that you will remain as my debt holder, no conversion clause, then if the project is successful and the things are going up, you still get your 2% rate of interest. But if you think that, oh, all right, we are the fair weather friends, and when the weather would be fair, then we shall convert a debt to equity. This gives you extra leeway, isn't it? You, of course, the borrower can refuse. The borrower can say that, no, I don't want it. Or you can give some ratio proportion. That, all right, I can give you every 10 euros of debt you give me, you have the right to convert 3 euros to equity. So for every 10 euros, so for example, let's say you give me 10 debt, no equity. After 3 years, you can have 7 debt and 3 equity. Right? And that also you can restrict, okay, I give to them, but not to them. You can even dictate your term. Okay, if you are insisting too much on collateral, I will not give you convertible debt. You know what I mean? Or you can also play. It's a bargaining strength. Yeah. So there is a bargaining strength. If you have really good chance to make money in the future, your project will be really successful. There's a high chance. All right. Well, then you will be having your head high when you negotiate. And that is why, exactly why, remember the topic of discussion is, we want your convertible debt. It means they also know that the project has very high probability of success. Otherwise, they would never negotiate it. All right. And then you know that, you know what, here is the time to strike. So it's like the business negotiation. And then you say, all right, then lacks the condition of collateral. I give you collateral, but I will give you only 50% collateral. And then I will give you the convertible right from not 2, but to 3. But if you want 75% collateral, then I give you 2 for every 10. But if you want to give me 100% collateral, if you want me to give you 100% collateral, then no. I don't mind, stay as my lenders for the rest of the life. So this is something you can negotiate with your convertible debt. Please go through it. Actually, I would rather you to go through the slide 14 and 15 by yourself. And if you have any points to share, please discuss with me. But now you know the ideas of convertible debt. Rest all are dynamics. So please go through it. Yeah. And then there are some benefits of equity. Like we had some pros and cons of debt. We also have the pros and cons of equity. The first benefit is that this is far flexible, right? And also you can bring in some strategic partners who have some very strategic capabilities to bring in. So they not only bring money, as you said, Fernando, that they can bring some other qualities also. So the company's skill capital or the skill formation level, the skill accumulation level can go high. And then there are some interventionist partners also. Interventionist partners are important, not because they are making fuss in the board meetings, but they keep the managers in check. And normally these interventionist partners are, or shareholders are, institutional investors, right? Because they don't buy your 1 or 2 shares, they buy the whole bundle of stock. So they have lots of money at stake. There is a fluidity owing to the secondary market. So normally in the equity market for the big companies, there is a secondary market. And even in the private sector, even in the private companies, not publicly listed company, if you are investing as a shareholder of a SME, which is not a listed company, then the company is doing better performance. The company's annual or the periodical valuation shows high value. So if you want to exit, somebody would give you high price, even in the non-listed companies case. So the listed or non-listed, it doesn't really matter. If your company's performance is going up and the company's valuation is going up, right? If you use the discounted cash flow method, if you use the Gordon's growth model, if you use a different CAPM model, if you apply them, and you find that the company's performance have gone up, even though you are a private company, it means that somebody is in the market willing to pay you that price. So there is a fluidity. There's a professional management. Normally in the equity run company, the people who run the firm are the agents. They may not be owners, but they're controllers. And what makes them the agent? Because they are professionally trained managers. Do you get my point? The professional managers, look at the word professional. They're professionally trained to run the company. You can be millionaire, billionaire, but you don't know how to run the business. But there are some specific, like what you are getting training for. When you complete your MBA, you are professionally trained managers to run the company because you have been through different courses. Look at your courses, look at your portfolio. You have I would say, a pretty vast portfolio. Then you learn many skills. You know the marketing skills, and hopefully you will know some financial skills also, how you can do some numeric calculations and articulate. All right. And by the way, one thing I forgot to share with you. The corporate tax rates are pro-debt, but the personal tax are pro-equity. You know, we have two types of tax exposure. The first is that the company who gives the earnings, debt or debt income, interest, equity income, dividends, or the capital gains, the stock price go up. The corporate tax, which I gave you this example, treats debt favorably and equity unfavorably. But that is not the only tax you pay. Don't you pay the personal income tax? Don't you file your tax return at the end of the year? You do. Yeah. So when you file your tax returns, there is a personal income tax, the individual tax, we call it. That is pro equity. Why equity? Because the personal income tax is more in favor of entrepreneurial income, not the fixed income, but the entrepreneurial income. And the share in profits is a entrepreneurial income. So in many countries, the capital gains are very low. I spent some time in very Anglo-Saxon countries in Britain for many years, and even more Anglo-Saxon, I would say, is Singapore, very purely capital market, capital-oriented, capitalistic. There was 0% tax on dividend income. No tax on dividends, no tax on capital gains. But on interest rate, yes, the personal income tax rate is high. How high? Well, 7% something. But when there is no, but there is 0%. So if the additional, if the corporate tax is tilted in favor of debt holders, the personal income tax is tilted in favor of equity income. Yeah, you can think about it. So when you do this finance plan, you can think about it. And then there are some, of course, disadvantages also. There is a more tax shield to corporate tax for no tax shield. Equity can be expensive in the sense that the listing requirements and all that system. If your company really want to become an equity based, sooner or later you must be listed. and listing is very expensive. And besides, I would say that equity some way makes managers less accountable than debt holders. Debt is very pushy, slightly intimidating, but and then you know that when there is a separation of ownership and control, the agency problem, then the utility function of the principal and the utility function of the agent can be different. You get my point? What makes you happier as a shareholder, right? All those factors which gives you satisfaction as a shareholder may not give you satisfaction when you are the manager of the company. The shareholders can ask, give us more dividends. The manager will ask, haven't I performed well? Shouldn't I give myself bonuses? You know, I'm trying to exaggerate. Or a good manager would say, why should I give you dividend? We have 10 projects to be undertaken. Let's reach that stage first. Come on, folks, show some patience. We have very high NPV, net present value, project in the waiting. And look, we've done a good job this year. We have lots of cash. Why don't we use our retained earnings to finance those projects? Then those projects mature, and then I can give you dividends. Please be patient. But they want something else. So this conflict is called agency conflict. Okay. Yeah, the sources of, I think this is, I know you can do by yourself, it's not a problem. And then there are some pre-IPO equity financing options. Before you go to the IPO stage, before you become a public listed company. Of course, we have friends and family who give us money. Triple F. Of course, I didn't write fools, right? Because the friends and family can also be fools. So you can fool them if you want. And then we have the angel investors. So the word is angel. Yeah? So they put their own finance in the growth of a small company, early stage. And they not only contribute, as Fernando mentioned at some stage, that they not only give you the money, but they also contribute in the form of managerial expertise, in technical expertise, so all the other expertise which they have done, which they have accumulated. So they are basically treat you like a toddler, and they help you to learn walking, but they're holding you on. You know? So they provide you a lot of support. Generally, the angels make their own decisions about amount of investment. So because you're in an early stage investor, the probability that you will be having a very clear-cut discussion across the table, like I did with you, I can do with a venture capitalist like this. Remember, I was telling you? The chance that I would speak to an angel investor is very less. But to a venture capitalist, I may talk like this. Okay. The amount of investment is pretty flexible because they will decide. In case of angel investors, the angels would decide how much they can invest and how many stages they think that, okay, this invest the first dose, the second dose, the third dose, and so on and so forth. Of course not. Yeah. Yeah. And the angels are not promoter investors. The angels are not promoter investors. The promoters are those people who have this idea to launch the company. They have the look, they may not be the experts. They may not be the entrepreneurs. The entrepreneurs are those who actually start implementing the idea with their knowledge, skill, but the promoters are those who think that, hey, you know what? I feel, for example, if I talk to you, I feel that in the coming year, the hotel business on western part of Finland is going to really mushroom. I'm a promoter. So I promote this idea that, you know what, let's do it. So I can buy some piece of land and things like that. But then I call you, and then you do the research as a professional entrepreneur. And you find, yes, I think we have this kind of hotel, but I think we should also include the chain of restaurant. All right. And then we both approach some angel investors. Right. So I'm a promoter in this case. You are an entrepreneur. Okay. So promoters, like in many countries, the promoters are very, very popular, very common, like in Asia, for example, or the promoters are very deep, and mostly the promoters are the families who start the business first. Do you get my point? The families who start, like in India, Reliance or Tata, those who own Jaguar in UK, they are promoters. They started the business, but eventually then what happened? The company become bigger, more and more investors come, all right? But what they do is that their shareholding is shrinking now, but the control is not shrinking. They keep, even though with the low shareholdings, people who will become CEO, what will company invest, they have a lot of role to play in these decision making, okay? But they are not promoters for sure. The angels are outside. Promoters are within the company. They start the venture. Angel who will finance them. They normally invest in the private placement. It's a very negotiable thing. Generally, the angel investor would be requiring the overall return on investment higher than the venture capitalist, because they're not only providing you money, they also provide you lots of other services. Yeah, so maybe they also like convertible debt to begin with. Yeah, and then they also like these prototypes to begin with. So if you think that, yes, you have really great business idea, and they would like to test your prototypes before they give you full sanction to market it. So even not only in financing, but even on your operational issues, they want to be involved themselves. Mm-hmm. Group of investors called VCs, the venture capitalist. And you can go through it, and please tell me if there's anything you want me to talk more about it. All right, then we have preferred stock. We also call it preference equity. The preference equity is that you are shareholders, but you are preferred over the other shareholders. So there are two types of shareholders. One type of shareholders have a preferential treatment over the other type of preferential shareholders. Remember the stage that you have a right to convert your debt to equity. But when you convert this right to equity, you can still choose type of equity. And the type of equity you may choose is called normal or the general equity, right? Or the other could be the preferential equity. The preferential equity is that preferential equity are mixing or entering somewhere between the debt holders and the common stockholders. Of course, the share of profit they will get will be after you pay tax. And these people, the debt holder will also get before them. But they have a clause that they might not have the voting rights. You know, when you become the equity holders, you have the voting rights. So they say, yeah, you know what, we choose not to have the voting rights. But we want that when you start distributing profit to the shareholders, give us first. Now the question is that, what if the company have losses? Well, then they suffer. Then they suffer. But if the profit is positive, then they would be standing first in the queue before the common shareholders stand. And what is the common equity? The common equity is that you have the voting rights. More shares you have, more voting rights you have, more votes you have. Of voting rights? Hmm. The reason they think that, after all, when we vote, like even in the political system, when we vote, we think that this party is better than the other. Sometimes you vote in favor of a party, or sometimes you vote against a party. You get my point? Sometimes I'm voting you not because you're good, but I vote against you because I don't like you, or I have seen you already, and that's called anti-incumbency vote. You get my point? So I just want to vote you because you have not been tried and trusted before, right? But there would always be some people who are very indifferent to vote. They say that, you know what, this guy has not performed well, and I don't really have high hopes on him. So there's always many people who abstain from voting. The voting percentage in a country is never 100%. Not all the voters vote. Do we agree? 60%, 70%. These are those people. They say that, hey, why do we have voting rights? Are we going to vote against this man or that man? We don't even understand the business. The company over time has become more complex. More subsidiaries, new people have come. The share ownership have changed. All right. And I don't think so. We find a little bit uncomfortable to do this homework. Who is good, who is not good. All right. Let's surrender the rights to vote. The company is doing fine. All right. The only problem can be that the company, when have less profit, we may be having less share. So let's become preferential shareholders. So, right, we give up our voting rights, but you know what? In turn, we want that we should have once the profit is getting distributed, we should be the first one to be in the queue. Hmm? Mm-hmm. The benefit is that there is some element of fixed dividend. It's like some kind of assured dividend, that there'll be certain dividend which we assure you will get. You may get on top of that also. In case of common equity holder, there's no guarantee, no assurance. But in this case, they make some kind of assurance that, you know what, if we have 30 as a profit, all right, then we assure that out of 30, the €5, the first €5, we will only give to the preferential shareholders, all right? And for the remaining 25, then we treat you all equal. So there's no fixed amount of dividend, but there can be some fixed percentage of dividend. That first of all, if we have profit, then let's say the top 10% is only reserved for the preferential shareholders. So once we have given you 10% of this, the preference shareholders, now only 90% is left, between 27 is left. Now this 27 would be shared between all of you equally, and you are also a member of this distribution. No. Theory is net profit, right? Profit after tax. The agreement is that preferred that first of all, if there's a profit, the first 10% will only go to the preferential shareholders, right? It means €3 have gone to Now 27 is left. And let's say there are 100 shares, right? Preferential, equity, everybody. But 3 is already done. It's only going to the preferential shareholders. Now 27 is left, right? This divided by 100. Everybody, including the preferential and equity, would get 0.27 per share. But this they have taken already. This is the profit. No, the equity is not equal. This is 30 euros, which we have decided to distribute among the preferential shareholders. And let's say that there are such, there are 10. Let's say the total shares are 100. 10 are preferential and 90 are common. All right. So 10 shares are preferential. Okay. Now, let's say 10% is reserved for only for preferential. It means that 3 euros are meant for preferential shareholders. And if there are 10 such shares, then each of the share gets 0.30. All right. Now 27 divided by 100.
Yes, that's fine. That's why get more. If
You are saying that how will the
ownership are equal, 10 shares or are valued?
Yeah, the market value, the book value is same.
Yeah.
Well, if you let me explain, I think that will be better. So the voting rights. That's what I said, that they don't have voting rights. No, it's not. It's legal. It's a right. They have a right. Come on. It's not a under the table deal that, hey, I will not vote, but please bribe me. Otherwise, it's called bribery. Wait a second. 30 is the profit. 100 shares, 90 common, 10 preferential. The deal is that, let's say, that 10% of the profit will first go only to the preferential shareholders, which means 3 euros, 30 each. 27 is leftover. Altogether 100 shares, 27. So basically, the preferential shareholder is getting this plus this, 57. Yeah. No, only voting rights. And I can show you, wait a sec, I can show you, you can, all right. So this is the phenomena of the preferred stocks. And then we have the crowdfunding thing. Crowdfunding is also a new phenomena. You want to approach a larger cross-section of investor who you can persuade to invest. You don't approach, when you approach angels or the VCs, they are very few. But here you are reaching a very big cross-section of the people. And each contributor of investment is very small, somewhat similar to the public listed company, but of course it's not listed, but you can approach, so your social media platform actually work like a stock exchange. because you use the social network to get this money. There are different kind of motivation. Some are intrinsic and some are extrinsic. Some people want to help you to get the funding through the crowding, through the crowdfunding, because they are genuine professional philanthropists. But some people help you to use this crowdfunding platform because they have a financial concern. You pay them some incentives. Many times I have seen with my own eyes that when people are asking for the crowdfunding on Facebook or some other social media, they also share, not all, but some elements of their business plan. And to some extent, the financial plan also. Okay. But remember, this is a social media platform. And there is a big problem. The big problem is that there is a regulation and redressal. Regulation is that there's no real rules how you can do the crowdfunding. And redressal is that if you are a victim of any crowdfunding scandal or a scam, it's difficult to get redressal. I mean, the law is unsure how to help you. If you see what? In every public listed company, there is an investor cell. You can file online complaint, and it has to be in the company's database. So every year, when the company publishes its annual reports, all right, there is a section called investors' complaints. And number of complaints are published every year. Oh yes, last year we received 25 complaints. This year there are 35 complaints. And the company is very transparent because they are done online. Nobody can manipulate. But here, if there's any complaint, the redressal is very difficult to get because this whole system is yet not regulated. Okay. Your social media, as I use the phrase that your social media or the Facebook is not exactly like, but comparable to an unorganized stock market or the capital market. Okay. Because it's unorganized, therefore the regulation is weak or almost absent in many cases, and the redressal is very, very complicated. Sometimes I have seen in many cases when people are donating some capital, it may not be always in monetary terms, but they also volunteer to help you through managerial or the other technical capacities. I'm a member of many groups of entrepreneurs on my Facebook, and I can see dozens of messages, and some of the messages say that, hey, you know what, if you need some managerial help, if you want some contacts, inbox me, and I can help you. Huh? Well, some people are. They won't be knowing that, because then you can say that, you know what, I have helped so many companies. So like sometimes you do the volunteering job. When you do this in Finland, what we call as a internship, there's a Finnish word. You had it, something like that. So you are helping, you're working as a voluntary assistant. So, you can be a student and still take part in the crowdfunding. Or if you are an established entrepreneur, you are a kinda established entrepreneur, and you think that by helping through the crowdfunding platform, you can get your presence felt. You know, many NGOs, for example, many these welfare organizations, they do welfare, but they do a lot of their marketing campaign also. So they use social media as a way of popularizing their brand. Yeah, they think that, hey, if the big companies can do corporate social responsibility, we are a small company. Of course, we can't spend millions on CSR, but can we have some small variation of CSR by helping other startups and also getting our presence felt, because people read when you are helping them. Okay? Or they can give you some reward, sponsorship, pre-selling and pre-ordering this is also one form of help, that when you're helping a company, that, hey, you know what, go ahead, produce what you are thinking. And I assure you that I would be the first buyer of your product. So you can give this kind of assurance. Pre-selling, you help them. And you also do the pre-ordering, that even before your product is ready, I am ordering you to sell me the first 500 units. And the company is assured, oh yes, 500 units multiplied by 50 euro. Oh, good money, why not? Or the normal lending and equity is nothing. So crowdfunding is getting very popular, but these all new channels of funding, they are, even though it's a one sentence here, regulation and redressal, but this factor, these two factors are so strong that we are still considering that, is it a, so this is something is a, because it's a new invention, let's not forget. And then another variation of crowdfunding is P2P lending. Okay. In the crowdfunding, you can also have the equity element. But P2P, as I said, is a variation of crowdfunding, but this is only for the loans and for the debt purposes. And this is something, P2P lending, of course, it's more popular nowadays, thanks to the social media, but even before social media popularization, P2P lending existed in one form or other. And how they will do was, their principle was full financing, that the company is negotiating with many possible bidders, and one who is giving a bid, offering the loan for the lowest interest rate, all else being equal, all right, would be accepted as a peer lender. Like bidding, you know, when you go for when you bid. So this used to be a case before the popularization of social media, that the companies would give their secret bidding to fund. And then the company who is going to receive this money, they will open the bid, and the one who is offering the loan at the cheapest rate of interest, but all other conditions equal. Like, for example, what should be the pledging period? Pledging means that for how long you have to keep your property as a collateral, all right? And the time period of loan, all right? So if all other conditions are met, then the one who is offering you the given amount of loan at a lowest possible interest would be accepted as the company's peer lender. But nowadays, for example, these are very active, and now we have very dedicated online platform who are not just doing the normal borrowing and lending, but also debt servicing job. They also do matchmaking, that who can be your potential lenders. So you can give your specifications, and then they can find from the pool of offerers that I think you should go with this kind of investor. So you don't even have to, you have to only give your business idea, business prospects, what is your time horizon. So you give them your wish list, all right? And they, by charging fee, normally they charge nowadays, if you go for some more professional P2P platform, and then they find that who is the best match for you. And then they also take responsibility of payments, installments, administrative fee, and if there is any problem, is any penal interest rate or not. So all these kind of, so they are a little bit more regulated comparatively to as they used to be. So there are many institutional online platforms now are working in the field of crowdfunding, especially in the P2P lending situations. Okay. And there we are.